This is Nick Kristoff with the Kristoff team, and today I want to talk a little bit about ARMs. With the rising interest rates recently, we've been getting a lot of calls and questions about ARMs. What are they? How do I know if it's a good decision for me? How do they work? All of those kind of questions. So I'm going to give just a quick video here today, but just to talk through what they are and how to kind of evaluate whether or not it's a good decision for you. So first off, what is an ARM? Well, an ARM is an adjustable rate mortgage. So in many ways, it is very similar to a fixed rate mortgage in terms of the overall loan itself, but the distinction is in the interest rate. So a fixed rate mortgage, like the name suggests, has a fixed interest rate for the entire duration of the loan. You might have a 30-year fixed rate mortgage or a 15-year fixed rate mortgage where that interest rate is fixed for the entire period of time. Whereas with an adjustable rate mortgage, you have an initial period where the interest rate remains the same, but then it would adjust for some frequency thereafter. So ARMs are usually named by how long that initial period is and how frequent those adjustments occur. So you might see something like a 10-1 ARM, meaning that it is an initial period where the rate remains the same for the first 10 years, and then the 1 afterwards would mean that it adjusts annually thereafter. So it might be a 30-year loan, initial rate of 10 years, and annual adjustments thereafter. You might see something like a 5/6M ARM. And that means that the initial period is 5 years where the rate remains the same, and then it adjusts with a frequency of 6 months. So you can see a number of different variations on how those ARMs are put together. That's the structure of them. And so the question that we get often is, does it make sense for me, or why do they exist? All things being equal, you typically see that an adjustable rate mortgage has a lower starting rate than a fixed rate mortgage. So that's why they are coming into kind of popularity again, or the questions are coming up, is because as rates are increasing all across the board, but particularly on the fixed rates, there's questions about whether or not an ARM would make sense because it starts with a lower rate typically. So when do you know whether or not an ARM is a good choice for you? Well, some of that can be answered by figuring out a little bit more about how an ARM works. So in terms of how you figure out what the interest rate is, the initial rate is typically set by whatever institution. It could be a combination of factors, but that initial rate is going to be based on maybe where the market is today or expectations of where the market is going. And then the adjustment rate will be based on some formula. So you might see a starting rate of some set amount for a period of the initial period, for 10 years, for 7 years, for 5 years, something like that. The formula then that determines the adjustable portion is an index. It's kind of the starting point. An index may be something like the prime rate. So when you hear that the prime rate is moving and you have an adjustable rate mortgage, the prime rate might be an index. Constant maturity treasury might be an index. So you take this index and you add in a margin. So you might have a prime plus 1 is how you determine the rate. So each adjustment, once you enter that adjustment period, that institution will figure out what the prime rate is. They'll add 1% and that will be your rate until the next adjustment period, and they'll do that formula on repeat. So that's how it would work after you finish the initial set period and you enter that adjustment period. So again, back to the question, how do I know if it makes sense for me? Most of the time we're talking through big picture timeline questions. So for one, if an individual maybe is selling another piece of real estate, they have it for sale or they anticipate to sell it once they maybe make a move from one location to another location. If there's a sale of an asset, there's going to be a significant amount of funds. That may be something to consider. The initial loan might be either significantly reduced and paid down, it might be paid off entirely, in which case that major life event might occur before that initial period is up, or the balance is so low that the adjustments aren't really going to have that big of an impact on the ongoing payment. Another thing that we often talk through are folks who have maybe someone in a family, it's an elderly situation or something like that, and they're expecting an inheritance or a large sum of money coming from a trust or something like that. Well, that can be another life event that you consider. Some others are maybe you have older children that are leaving the home or finishing college, to where Right now, it's helpful to have that lower payment, but in 5, 7, 10 years, something like that, you know that that college tuition payment is going away, and you have the ability, if you need to afford a difference in payment, but you want to be able to acquire that property with a lower payment now. So those are just a few examples. They're not going to fit every situation, but that's the kind of conversation we walk through in comparing fixed rates, adjustable rates, how they work, what the expectation is on the market going forward, and then whether or not that's a good fit for you. So if you've got questions about ARMs, how they work, how you compare them versus fixed rates, and whether or not it's a type of mortgage that would make sense in your scenario, feel free to reach out to the Kristoff team. We're happy to help.